Hello and welcome to the third video for Chapter 11. I'd like to move us ahead to page 1115, and now let's talk a little bit about S corporations. Okay, S corporations are fairly popular. They're a lot of times when businesses start up, and like I said, they automatically become subchapter C corporations, and even worse, if you are a personal service corporation, in other words, you're an accountant, you're a doctor, or a lawyer, or somebody like that, personal service corporations are automatically taxed at 35% regardless of their income. Okay, so in other words, you would not get to use, the table at the beginning of the chapter for a personal service corporation. You would just tax them at a flat 35%. All right, so what a lot of small business people would do is they're going to go, well, is there any way to avoid that if you're a service company? And yes, there is. You can form an S corporation. So S corporations pay taxes at the individual rates. So if you're in the 15% bracket, including your S corporation pass-through income, you will pay taxes at the 15% instead of at the other rates that are shown at the table at the beginning of Chapter 11. Okay, so again, S corporations are mainly what would you call family-type corporations. They, if you notice on page 1115 that there are four requirements to become an S corporation. Number one, it has to be domestic. All right. In other words, it cannot be based outside the United States. Number two, the corporation has to have 100 or fewer shareholders. All right. So for somebody just starting up a corporation, probably wouldn't have that problem. But as the company grows, okay, you could end up having more than 100 shareholders. All right. Number three, the corporation can only have one class of stock. All right. Okay, so you can't have like A and B shares, or you can't have preferred stock or something like that. All right, and then all shareholders have to be U.S. citizens or resident aliens. Okay, now how do you become an S corporation? Well, like I said, the way it is normally done is, like in Indiana, all right, you'll apply to become a corporation. All right, it's pretty simple, as long as you are not using the name of another established corporation. You'll get to use that name. You pay about $90 and as a startup expenditure, and then Indiana sends you your certificate of incorporation. Okay, all this is done usually by email, unless of course you hire an attorney. All right, so the next step then is to get your EIN from the IRS. So when you fill out Form SS4, all right, to get your EIN, the IRS will ask you, well, what are you? And you tell them, well, I'm a corporation. And they're going to want to know the end of your tax year, which is usually December, and, a bunch of other questions. Okay, and then when you get your EIN from the IRS, all right, it'll tell you that you are a subchapter C corporation and that your first tax return will be generally due April 15th of the following year. All right, so what you do is you file Form 2553. That's Form 2553, okay? And you immediately ask to be treated as a subchapter S corporation. All right, if you do it immediately, all right, then you'll get to be a subchapter S corporation for the whole year. If you are a calendar year company and you wait until after March 15th of the next year, okay, then you can't become an S corporation until the following full year. So basically what I'm saying is let's say you incorporated in November of 2018. All right, and you did not apply to become an S corporation until April of 2019. All right, well, you would have to, you generally would have to file as a C corporation for 2018, and then file as an S corporation for 2019. Okay, so the idea there is try to file Form 2553 immediately after getting your EIN from the IRS, so you can be treated as an S corporation from the get-go, assuming that is what you want. Okay, all right. Keep in mind that the tax return for an S corporation is due March 15th. All right, not April 15th like C corporations. Okay, they pushed it back to March 15th because remember, the income from an S corporation passes through to the shareholders, and the shareholders have to report that income on page 2 of Schedule E on their Form 1040, and they have to do so by April 15th. So the S corporation returns due March 15th. The individual return, of course, is due on April 15th. Okay, all right. So if you know, one of the good things about having an S corporation is that if you have a loss from your S corporation, okay, then that loss is treated as an ordinary loss on your tax return. So it can be deducted against, you know, for example, wage income or any other income that you have on your return. Okay, if you look at page 1116, okay, they also talk about there are separate pass-through items very similar to a partnership, okay, that you have to watch out for. Okay, those items are, of course, capital gains and losses that'll pass through to Schedule D on your tax return. Section 1231, gains and losses, that usually passes through to Form 4797. You have dividend income that'll pass through to Schedule B. Charitable contributions, that'll pass through to your Schedule A. Tax exempt interest, that'll pass through to Schedule B. Of course, it's, you know, tax exempt interest, by the way, still has to be reported, even though by its name it is tax exempt, right? But you still have to report it, all right? You just don't have to claim it as income. All right, okay. So the other thing that you have to watch out for is if at one time you were a C corporation and then you became an S corporation, there could be some taxes that would be due on the accumulated earnings and profits from the C corporation, but that's a little bit beyond this class. Okay, that ends this video on S corporations.